And now we will go through the Q&A session. Thank you.
Thank you very much, Fernando. Because they say it's good to break habits sometimes, so we decided to break a habit of accumulating questions into subjects. Also, because we have some very active analysts, we decided to honor some of them. So the special mention reward goes to Noemi Peruch from Mediobanca. She's always first with questions, and she fired quite a number of these, and we will go one by one, and hopefully these will cover quite a number of area of interest for pretty much everybody. So first question from Noemi is, are there any non-recurring items in cost in the second quarter, or is this new run rate for OPEX and staff costs?
So regarding staff costs, nothing extraordinary in this quarter, non-recurring. Regarding admin costs, of course, we have the effect of, on one side, we did not have the contribution for the resolution fund that is booked once a year in the first quarter, but additionally, we had the release of part of the provision that we had made for this contribution in the first quarter, which translated into reversal of a cost of around 23 million, if I'm not mistaken, that we had booked from the first quarter. So this can be considered a non-recurrent item because the actual cost in the first quarter should have been lower. Apart from this, there was nothing else significant in the second quarter.
Thank you very much. Continuing with questions from Noemi. Cost of risk was particularly low in second quarter. Was there any single name release? Would you update your full-year guidance for cost of risk?
We said also in the press conference in the morning that the quality of the credit is very high, and of course, especially that we keep very low unemployment, and we are even foreseeing a decrease of the interest rates. The guidance would be more on the 50 basis points instead of 60 that we were giving in the beginning of the year.
And this low cost of risk in the second quarter was not driven by a single, let's say, release. It was a combination of factors. One of them we already mentioned was the sale of NPLs. And a number of other verification of criteria of the classification of the loans, and so we of course it was clearly better than the first quarter, and we don't see signs of the deterioration in any of the, let's say, 4 critical portfolios that the bank has, which means mortgages, consumer loans, corporate loans, and leasing. And so that's why we are more optimistic regarding the cost of risk for the year.
Also, it's probably worth mentioning that there is a bit of a mathematical contribution because our book is not growing very fast, and in some segments it's even decreasing. So there's no dilution effect that you would see otherwise. So also you have to factor this into account while forecasting our cost of risk for the full year. Continuing with questions from Noemi, this time it's on NII. We have seen deposit costs going down in quarter on quarter. Could you please give us some color on customer behavior and competition? Do you expect competition and appetite for term deposits to soften going forward, so deposit rates do not move much?
Deposits is also a lot of mix and price management. In a simplified way, quarter to quarter, we have 2 billion of time deposits in corporate that decrease and 1.5 billion of time deposits in retail that increase. And of course, the corporate time deposits are usually at a higher level than retail. So I would say that besides a more prudent price management, probably this quarter, with the teams in marketing also understanding that scenario of decreased interest rate is coming, but this is change of this mix as well. In terms of the competition, in terms of the products that advertising and everything, it's too early to see the effect, but it's visible that even the offers in retail now are more attached with some conditions or activity or new customers or some additional products, and not so much a plain vanilla time deposits with high prices. So we believe that we are going to see this decrease. However, I would alert that, as usual, the credit adjusts very fast and the deposits adjust very slow. So when we had the increase of the interest rates, this was very beneficiary for the banks. And as soon as we will have the decrease of the interest rates, this will be less beneficiary in the banks in the beginning. So we will see the repricing of credits to go faster than the reprices of the deposits.
Thank you. We're moving slightly away from numbers. When do you expect to leave the recovery plan? When do you expect to have visibility on moratoria?
So the recovery plan, we need to issue MREL. So we were very transparent last year in setting the priorities. So we explained that first we will address the capital and then we will address MREL requirements. We end up to be faster than we forecast, so we end up to solve the capital ratios at the end of the year. And now we are happily, we see this progressing and even increasing the buffers that we have versus the minimum requirement of the capital from KNF, so it's fine. And now we are addressing MREL, and as soon as we address MREL and we have visibility that we will not have any constraints, and also it's also because when you leave the recovery there is consequences like paying banking tax and everything. As soon as we feel, then we will apply to this situation. And in terms of visibility of moratoria, this we don't have any visibility at all, because the moratoria appears without any reason and without any possibility of being expected last year, and so it's completely unpredictable. Of course, it's difficult to understand. The market have embedded a decrease to 6% reference rate at the end of this year and 4% reference rate at the end of 2024. It's difficult to understand the justification for credit holidays in this environment. However, it was also difficult to understand justification last year, so we don't have any visibility.
Could you update us on your MREL issuance plan? Are you working on further RWA efficiency measures?
So starting with the RWA, of course, we are always looking at further ways of optimizing risk-weighted assets, namely through additional securitization of synthetic securitization of assets, and so we will be continuing to explore this route. The transaction that we have concluded in July is already the third transaction since the first quarter of last year. We finished one in March last year, another one in December, and this is the third one of leasing receivables. And so it is still possible that additional will come, but it's still too soon to mention about potential impacts of such transaction. Regarding MREL, so first, the improvement that the bank has shown in results, operational profitability, but also in terms of its capital position, has been supportive in terms of reducing the gap to fulfill the MREL, not only the interim level that we are obliged to fulfill now, but also the final level that is in force from 31st December onwards. Second, our MREL requirements were lowered in June, as communicated to us by the Banking Guarantee Fund, and as we reported in a current report, as a consequence of the reduction of the Pillar 2 buffer done by KNF in December last year. So the third, as a consequence of the improvement on the capital ratios, and also all the improvements on the capital ratios also have immediate benefit in terms of reduction of the issuance needs for MREL. We are analyzing the market and monitoring the market conditions in order to see the possibilities of issuing bonds eligible for MREL during the second half of the year, because as it was already said before, we have as a target to fulfill the MREL requirements, the ultimate ones, by the end of the year. The progress that was achieved during the second quarter is that we already fulfilled the minimum one, I'm saying the MREL without the combined buffer requirement, and of course now we want to fulfill all the MREL requirements until year end. So this is the plan.
Thank you very much. Next question from Noemi. Could you the trends of incoming lawsuits and settlements were encouraging. What recurring level of FX provisions do we expect going forward?
So we tried several times to explain a little bit how we are addressing the negotiations and the settlements and everything. We explained that we have a team of 150 bank professionals that interact in a constant basis with the clients and registered all the interactions and trying to find whatever the solutions is possible to them. This means that even when we have legal scenarios that are very disadvantaged for the bank, there is a constant line of communication, and we try to find solutions for settlement, amicable settlements with the clients, even in this situation. It doesn't matter if they are in court or if they are not in court. So it's always a trend. 2 quarters or 3 quarters ago, I explained that due to all the settlements that we have done, it would not be possible to maintain this target of 2,000 settlements per quarter, and that we would move to a more 1,000 level. And this is more or less what we are working. We would like to cross these 1,000. We are making 900 and something, so it's okay. This is. In terms of trends, it's difficult to assess yet what is going to be the trend. So we never know what we are receiving from courts, if it is what are the customers engaging lawyers, because there is of course here in the legal system also a bottleneck. So it's something, but from what we see now, the trend is similar, and so we had already quarters with higher levels and quarters with lower levels, and it's in very basic and round numbers, we are for a long time on these 500 court cases per month. So it's or 1,500 per quarter, and we don't see. We already saw quarters that were more. Now we are seeing quarters that is less, but also we are not taking a conclusion that is slowing down. So we believe that is stable. In terms of provisions, I will start, and then Fernando see if you to say something or not. So we try to disclose, and this time we are disclosing even more, as much as possible the methodology that we are using. We always explain that the methodology, at the end of the day, the biggest impact is number of court cases and the results of the courts. At the moment, the results of the courts are already in the maximum that we can put in probability to lose. So now I would say that the driver is the number of court cases, but maybe you want to address something more.
Yeah, so of course this is always a tricky question, because of course we have been facing for several quarters some negative developments, and so which then contribute to the continuation of this provisioning effort, and during this first half of the year, especially we had the elimination of this factor of remuneration for banks due to this European Court of Justice judgment, and also some more conservative adjustments connected with the inflow of the number of court cases, which turned out during this first half of the year to be higher than what we were thinking it would be in the fourth quarter of 2022. And so these were two drivers of the increased level of the high amount of provisions during this first half of the year. Having said that, so going forward, of course, what the drivers of provision will be connected with the inflow of the court cases and the trend. Also is also important the level of the settlements that we'll be able to achieve with customers in court cases and outside of court. So this is also a driver, and also any other developments in terms of jurisprudence or in terms of court decisions that also can influence the loss that is booked regarding each case. So, of course, we don't expect in the second half of the year extraordinary events such as the ones that happened in the first half of the year, right? So, from this perspective, of course, we should expect a lower amount of provisions in the second half of the year than in the first half of the year. It's very difficult to give a concrete guidance for quarter-by-quarter provisions because, as I said, there are multiple things that influence, but I would say that it's a general statement that, of course, we would expect that the second half would be less costly than the first half.
Thank you. Now we're making a leap into a totally different area, and the question is, what is your NII sensitivity to 100 basis points rate cuts?
Okay, we were expecting this question, to be honest. And so I would start. So first of all, we are disclosing this estimation in our first half report on page 40 and 41 of our financial statements, and and of course there are always some assumptions underlying the estimation, which we are also disclosing, but the answer is that a decrease of 100 basis points immediate, and assuming that all the assets and liabilities would be already aligned with the currently existing level of interest rates, would translate into a 2% impact on the group's NII reference level. So it means that the next 4 quarters would be lower by 2% and the last quarter annualized. Again, this is based on a number of assumptions. It's also based on the fact that part of the assets are at fixed rate or temporary fixed rate, because we also have a question about some hedging strategies later on. So of course, I would connect the answer to that question. Of course, what protects the bank against decreases of interest rates is on one side, the bond portfolio at fixed rate that exists, which is divided into 2 components. One is the hold to collect and sell, and the second one is the hold to collect portfolio. So this provides a cushion against decreases of interest rates, at least for the period of the duration of the bond portfolio. And the second is also the fact that part of the loan portfolio of the bank is at fixed rate. One is fixed rate for the product as per se, namely the consumer loans. They are sold at fixed rate for the lifetime of the contract, and the mortgage loans in the recent quarters has been especially done at periodically fixed interest rate, which means the interest rate is fixed for the first 5-year period, and so this also provides some cushion against the drops and reduces the sensitivity.
Now we have to bit improvise, but let me handle that.
Sorry, there's one question. If our combination of our term deposits is linked to WIBOR or fixed. If we don't have deposits indexed to WIBOR.
Okay, we partly answered the questions regarding the sensitivity or plans to reduce the sensitivity of our NII or interest rate-linked assets to rates, as Mr. Bischoff said before. There is a question from someone calling himself Santander. So Santander is asking us actually a question that many of our colleagues would like to hear answer to. The question is, does Bank Millennium plan further salary increases?
Yes, so we have active management of the personnel. The increases of salaries in Poland have been very dynamic. Also for us, it's very clear the cost of the attrition and the time that takes to recruit and train and to have full capacity. So the bank have a tradition to twice a year assess the employees, and as a consequence of this assessment, there is groups of employees that have raises, and we will keep the policy as we are doing. So this is clear. And there is also some questions about but I think we already answered about when we start to pay banking tax and everything. So we already answered also to the leave when we will leave the recovery plan.
Also a question from Jaromir from PKOBP. Did you book any special income tax shield in the quarter? Sorry, I lost this question, but it's effectively about...
So on a regular basis, of course, we review the treatment from a tax perspective of different revenue and cost items. In this particular quarter, there was also a reassessment of the consideration for tax cost of some provisions that existed associated with FX mortgage, and this translated, in fact, in some reduction, let's say, of the tax rate for the quarter due to this review that was done during the second quarter. So, of course, this is a regular process. This quarter there was let's say a bigger impact, but as a standard, we are always analyzing from tax point of view which provisions should be treated as not a tax cost, and as you know, unfortunately, for the time being, we are treating most of the provisions for the FX mortgage legal risk as not tax deductible, although we are, let's say, launching actions in order to fight against this interpretation, and then there are some other provisions which also we are assessing whether they can or not be considered as a tax cost.
Thank you. There is also a question from Maciej from Trigon. Do you plan to join the government 2% mortgage program? If not, do you see chances to increase new mortgage sales?
The market of the mortgage is of course very disturbed by all of the lack or all of the legal problems that we had around mortgage. So it was all of these saga in Swiss francs, then the unexpected credit holidays, then this not prepared change of indexant, so the WIBOR change. So it's somehow, and now we even are waiting and seeing what will be the reactions and the customers' expectations / consumer protections when we will have decrease of interest rates, and what are their interpretations for for fixed rate, if it is fixed rate, or if there is any expectation less normal as well. So for us, we didn't assess for the time being as necessary to join this program, and we will keep assessing and studying if the program justifies us to make all the developments and efforts to join it. But I must say that we are more committed for the future to keep growing in consumer lending. We were very happy with the results that we achieved this year in consumer lending. Customer acquisition, also we are very happy. As Fernando said, also we in this presentation, we gave a little bit bigger flavor in terms of SME mid-corporate. We had some, of course, capital constraints, but we believe that in the year of 2024, at least last part of that year, we could be back in the game and trying to grow the portfolio of SME mid-corporate. In terms of mortgage, we will do our market share, and we do not have any intention to excel in this area. We believe that, unfortunately, the legal frame in Poland does not advise us to make big efforts in terms of long-term credit for the time being.
Thank you very much. Maybe it's time to ask two questions from IPOPEMA, from Marta. First is about, I understand, outlook for court cases in the future. What the bank sees in terms of client interest in case of history of the mortgage loans, I think it's a certificate, right? Which would indicate higher level of court cases in the following quarters.
Yes, I understand the question. Yes, I understand the question. So, what we expressed before, we still don't see a significant increase or change of trend in these type of indicators that could lead us to the conclusion that a significant wave of new cases will come. So that's why we still believe that the average, at least for the nearest months, will not be substantial. The average inflow of court cases is not going to be substantially different than the one that we have shown during the first half of the year. It's something that we need to monitor every time, and of course we are not excluding the possibility that the number of court cases will grow towards more the end of the year. But for the time being, looking at what we can anticipate for the next 4 months, 5 months, we are not seeing, let's say, a significant change of the trend.
Another question from IPOPEMA is there any increase in usage of banking support fund? I mean, it's borrowers support fund, effectively, right?
Yeah, so this access to the borrower support fund has fluctuated through time because it was growing last year until the moment that the credit holidays were introduced. Then it dropped. Then during the first half of the year, there was again some increase. And of course, we also pay special attention to understanding what is behind the requests that are submitted to have access to the borrower support fund. And we are distinguishing between the underlying reasons. So when we see that the reason of submitting the request is connected with unemployment, of course, we treat these in a, let's say, as a more serious situation than other reasons that can be underlying the request. So the answer is there was some increase during the first half of the year, but when we look at the underlying reasons, the critical reason, which is unemployment, is still not significant. So it's I don't have exactly the percentage, but it is not the dominant one when the clients are asking for this. So sometimes it seems that it is also a way of somehow managing some temporary, let's say, lower disposable income or higher inflation, but not necessarily a sign of problems in terms of servicing the debt.
Thank you. There's one technical question, which I think we may answer to the benefit of all the participants. The question is coming from Marcin Czaplicki from PKO BP. What is included in the category other within other administrative costs? In the second quarter 23, it was minus 21 million, while in first quarter 23, in second quarter 22, it was positive.
This is partially connected with some settlements that occur from this is connected with some settlements that happen from time to time with card companies and that are not regular through time, and that's why sometimes we have this fluctuation in terms of the cost. So this is the main reason.
Okay, thank you very much. I think we have answered, I mean, not all questions religiously, but we have covered all the questions that were included, all the areas of interest that were included in the questions, unless you think otherwise.
Let us check.
Okay, let's quickly go through the questions so that no question remains unanswered.
Of course, there was a question if the bank is taking some steps to limit sensitivity to interest rates.
And also about the hedging,
about the hedging, I think I partially already explained how we are managing and how we are limiting the sensitivity.
And this is a global hedging. This is not a mathematical hedging, even because a mathematical hedging would create other problems when the early repayment of a fixed interest rate loan can happen, and these kinds of things. So it's a combination between, as you said, and having credits in fixed interest rates and also a balanced portfolio with different maturities of fixed interest rates of bonds. And also it's very important to understand that nothing is more efficient than a good price management as the conditions are changing. So it's also important. In Poland, the traditional time deposits are 3 months, or even I would say up to 3 months. So there is always a active repricing that needs to be done in order to offset, of course, also keeping loyal customers and not being the first to cut, but there is a need of an exercise when we have rate cuts to, in a very proactive way, to reprice the portfolio, although, as I said, and it's very important that everybody understands that this should be expected, because we saw exactly the opposite when there was the hike of the interest rates. Even you can see here, we have a page, is the page 11, you see that in the past, the end of 2021 and then the first 3 quarters of 2022, the speed of the interest on loans and the interest in deposits is completely different. So there is the repricing in deposits is always later, and it takes longer. And when the rates are going down, this is of course not positive for banks.
And connected with this, there is also just the last question that I see that I did not address directly, which is the NIM outlook for the next quarters, which is connected with exactly this point. I think to a large extent it depends on the actions that will be taken by the Monetary Policy Council later on in the year, and how quickly these interest rate drops will happen. So, of course, as we said during the presentation, the NIM improved in the second quarter. This was better than what we were initially expecting, but the interest rates already started to go down. WIBOR is already starting to go down, already reflecting this anticipation of expectations of a decrease of interest rates. So we cannot expect that the NIM will hold up at the current level, and it, of course, will tend to go down. It's very difficult to provide exact guidance on the evolution of the of the NIM when we have now this process that probably will start of gradual cuts in the interest rates. Of course, we tried to protect what could be protected in advance, but there is always some impact.
Okay, gentlemen, thank you very much for your time. And João, as usual, or maybe any closing remarks that you may have in mind?
I just said a lot. So so from one side, we are quite happy with the results. We are not only with the capacity to absorb the costs in Swiss francs, and it's also important to understand that we are materializing the biggest risks. So there were always two risks since the beginning of the year. One was the decision of European Court of Justice and the consequences of that decision, and this was a shadow during all of the first half of the year. And the second one is the credit holidays and in what conditions. So we believe that sooner or later we also will have this outcome. And so the materializations of the risks, it's always good for the financial markets because it takes uncertainty outside, looks to all of us that the impacts end up to be lower than some of the scenarios that were forecasted. And we are not saying that this is a total cost, because this is of course an impact, as Fernando said, that it's too early to see the end game. We don't see with the methodologies that we are using to see more cases, but we are not also saying that is over. We are not far away from that. But of course, after this exercise, and especially now that we also reinforce the capital and we have these good results and also this strong efficiency, because one of the things that we are quite happy is not only the volume of sales and net interest income, but also the capacity to have control costs in this very tough inflationary environment and with zero unemployment also in Poland. And these make us to be quite optimistic for next year, because it's also important to understand that the NIM will be lower, but the credit appetite, the credit demand changes completely with the environment of interest rates, because it's very costly to have consumer credits when we have, or credit card credits and everything, when we have a reference rates of 675 basis points. So in top of that, you are putting the commercial margin and the risk cost and everything. So the game changed completely if we have an environment of 4.5%, 5%, or 4 even. So it's we will have less gain per transaction, but we hope more gains in more transactions, and these make us look with a very optimistic eyes for 2024, and of course for the close of 2023. But we are already looking for 2024.
Gentlemen, thank you very much. Thank you very much, all the viewers, for the time and interest. For those who call us from hot locations or geographies, I can make a little bit envy. We see raindrops on our window. So we had a bit of cold breeze or cold weather. It will not last, though. And lastly, there was a lot of articles recently about how the tourist traffic or directions or patterns may change going forward. So do come to Poland before the crowd, basically, and do come and visit us to see Bank Millennium, to see the wonders of Poland, to see the wonders of Poland. And otherwise, we hope to see you in late October with the release of 3Q results. Thank you very much. Have good holidays and relax. Thank you very much.